is a basic building block in accounting. It's very important, so please make sure you spend some time on this because it's going to build upon, or we're going to need this to build upon the rest of the semester. So we really want to spend some time understanding what this is and how it works. The accounting equation itself is fairly simple. You got A equals L plus E. Okay, just use this in an abbreviated form, but what that means is that assets are equal to liabilities plus equities. We're going to talk about what that means exactly in just a second. But this is, as a mathematical equation, an identity. The left has to equal the right. So the value of all of your assets has to equal the value of all of the liabilities and the equities combined. This also gives way to what we refer to as a double entry bookkeeping system or a double entry accounting system. And that means that at all times, with anything that happens within a business, all business transactions will have a minimum of 2 accounts affected for each transaction. And these are the basic categories of accounts. An account can be an asset, a liability, or an equity account in general. Okay, so if you had, say, something that affected your assets and it increased your assets by $50, well, you can't stop there because this equation doesn't equal or it doesn't balance at that point in time. You only have one thing, an increase of assets of $50. Well, what else happened? Something else has to happen. So we always have to make sure that this equation is equal or in balance at all times. So that means that at least 2 accounts will always be affected or impacted. We could have more, but as a minimum, 2 accounts always will be affected. Let's look at what each of these pieces actually is. The first one, assets. As a very generic and general definition, assets are what the company owns or resources of the company. So think about, make it easy. Think about something that you actually own. Maybe you have a pencil that you're taking notes with, perhaps. Do you own that pencil? I don't know, maybe you borrowed it, but what if you owned it? Well, then we could say that that's a personal asset. You own that. You could put that down as an asset if you were making up accounting records for yourself. I know that's what you've been waiting to do. A company can own lots of items. All right, pencils could be, maybe that's part of their supplies. They might have vehicles that they own. They might have buildings that they own, equipment, land. Maybe they have a checking account, hopefully, and that would be cash. Or maybe they have a savings account. Okay, also, again, things that are owned. Perhaps they bought stock in another company as an investment. Those investments are assets. One that is used frequently that you may not quite know what it means at this point is something called accounts receivable. Accounts receivable is a type of account for customers that have either purchased items with us or we have provided services to already, but they have not yet paid me for them. So for instance, let's say that you came in and I did your taxes, but you didn't pay me. I sent you a bill later. Right now, you're an account receivable on my books. You owe me money. That's also an asset. Or you go into let's say, an office supply store and you charge some letterhead or some paper or toner or pens and pencils, staples, rubber bands, I don't know. And you say, just put that on my account, send me the bill. Well, that's an account receivable for that business. You now owe them money. Okay, those are assets. Prepaid accounts. For instance, let's say that you're an insurance company and you have people that pay their policy 6 months at a time. So that customer comes in and pays you for a 6-month policy. You have all of the money up front. Well, that is an asset to you. That's an asset to the company. So if my business paid their auto insurance for 6 months, I haven't used that insurance coverage quite yet. So that's an asset for me. It's a prepaid account. So we could just say prepaid insurance, for instance. Okay, those are also assets. Liabilities, again, in general, would be things that we owe. Specifically, these are rights of creditors. So let's switch some of my examples that we used before. Let's say that you're the office supply store now. And so that person came in and bought all those things and took all those things with them, but they didn't pay for them yet, okay? If we were the office supply store, then that means that that customer owes me money. That was an account receivable, that's an asset. But what if we were the person that came in and purchased those items? So that was your company. You went and bought office supplies, for instance. But you said, hey, just put that on my account. Send me the bill for it. We'll pay you later. Well, don't you owe them money now? Yeah. So now that's a liability for your company, the company that actually purchased and took the supplies. So that is what we call an account payable. You owe someone money, a vendor or supplier, for the product or service that you received from them. So in turn now you owe it to them. You show that on your records as a liability, the amount that you owe. Anything pretty much with a payable at the end of it represents a liability or a debt, something that you owe. So wages payable, or taxes payable, or interest payable, or notes payable. All of those would be some form of a liability account. One other one, we use the example of the insurance company when we went in and paid our policy, and so now we have a prepaid insurance account. It's an asset. But what if we were the insurance company? Well, if I'm the insurance company and I have a 6-month policy that's paid up front, I already have all the cash for it, I haven't actually supplied them any insurance coverage yet. I owe them that coverage for the next 6 months. So that's also a liability to me. I have to provide them with that coverage. I owe someone something. Also a liability. Equity accounts. Equity deals with the rights of owners. So these are things that have to do with ownership, right? Now, equity gets a little bit more, I don't want to say confusing, but it gets a little bit more complicated than what we were described with assets and liabilities. They were nice, we talked about them, gave you some examples, but equity has some more subcategories to it. Equity is kind of the top, is in a classification. Underneath that, we have two broad categories. We have capital stock, and we have retained earnings. All right? Capital stock is investment by your owners. Now, your ownership structure can differ. For instance, if you're a sole proprietor, this would be that you literally just put money in the say the checking account was low and you decided that you were going to put additional investment in the company. Not a loan, you just an additional investment. That would be a form of capital stock. If you were a corporation, however, this could be when you sell stock for, again, you're giving out additional shares of ownership, but you're getting cash in return. So that stock that you sold, physical stock, would be considered a part of capital stock. We'll get into more specifications with actual stock transactions with the corporation chapter. So that one is one type of equity. Then the other type would be retained earnings. This is where you show how much of your earnings you have retained over time. It's a cumulative account. So this is where all of your earnings kind of build up, a cumulative total of them for the entire life of the business. To do that, we have to consider three further subtypes of accounts. I told you this one gets a little hairy. So, under retained earnings, we're going to have revenues, expenses, and dividends. All right, let's go back to the first. Revenues. Revenues are accounts that show basically what do you do as a business. For instance, the insurance company, we sell insurance. So that would be our revenue, what it is that we provide, a service or a good. Okay, so an accountant's office, for instance, we do taxes. Tax revenues. Let's say that I charged you $100 to do your taxes. That $100 represents a revenue. It's the value of what I've provided for you. Okay, so revenues are a part of equity accounts, specifically under retained earnings. Expenses are those items that we incur as a type of cost to operate our business. So if again we were the accountant's office doing taxes, we would probably have things like a light bill that comes in. That's a type of an expense of doing business. Or we might have people working for us that we pay a salary or wage. Those are expenses of the business. Okay? A lot of different types of expenses. Usually expense accounts are pretty easy to identify because most of the time they have the word expense after them. Not always, but most of the time. So these are expenses. The difference between revenue and expense is the profit or loss of the business. That's why we have that retained earnings part. But there's one other type of account to consider, and that is dividends. Dividends is a special type of an account where it's like saying, hey, thanks for being an owner or an investor, and we'd like to give you something back. We can give them a dividend. You could literally write a check out and say, hey, I want to give you a dividend. Okay? It's kind of like an expense account, but it's a special account all unto itself, right? Because again, it's like giving your investors something back. So these three things, however, are part of retained earnings. They'll all eventually get put into the retained earnings account each year. Each year we're going to take each of these and kind of dump them into the retained earnings. We'll talk about that later when we talk about how we close the accounts each year at the end of the accounting cycle.